Hi, good morning, everyone. My name's Antony Lewis. I'm here to talk about my favorite topic, which is security tokens. It's the marriage between crypto and enterprise blockchains, and I've spent some time in both. I've called this talk Unlikely Bedfellows because the cryptocurrency folks and the enterprise blockchain folks from banks used to hate each other, and now they're starting to kind of warm up to each other. So just to give you a little bit of background of where I'm coming from, I used to be a spot FX trader for a bank, and then I moved into banking technology. So I've done half of my career in financial services IT. In 2013, I moved to a tiny Bitcoin startup called itBit, which is a Bitcoin exchange originally based in Singapore and then moved to New York. It's now called Paxos and is famous for its Pax stablecoin and Pax Gold and some other Paxy stuff. I left in 2015 and started writing a blog called Bits on Blocks. I felt that there wasn't enough information between the very low-level technical stuff, the white papers, and then the very high-level journalistic articles that you read in the press, but doesn't really explain things very well. So I started writing this blog, and through the blog, someone contacted me to write a book. So I published the book, The Basics of Bitcoins and Blockchains, which is great. My mother really likes it, even though she still doesn't really understand what I do. And then for the past 3 years, I've been working at R3. R3 is an enterprise software company. We sell blockchains to banks and other businesses, not just the financial service industry anymore, but we started from banks, and now lots of people use our blockchain platform, which is called Corda. So R3 is the company, and Corda is the blockchain platform. So what I really love about this year, having spent 3 years in Bitcoin and cryptocurrencies and 3 years in enterprise blockchains, is they're starting to come together. So we're working with incumbents and traditionalists and bankers, and I know we heard this morning, maybe some people in the room aren't particularly fond of the way things work today and aren't particularly fond of bankers, but there we go, we work with them. I also love, on the other side of the screen, I love the libertarians, the disruptors, people who are trying to change the paradigm, change the way we move money around, change the way we move assets around. And they're kind of really far apart, and they historically have been really far apart. And if you're on crypto Twitter, they hate each other, as we all know. But these guys are starting to discover crypto slowly over the past few years. They've kind of warmed up to Bitcoins, blockchains, Ethereum. I remember a time not so long ago, maybe 2 or 3 years ago, where bankers on stage weren't allowed to say the B word. They weren't allowed to say Bitcoin, but they were allowed to say, yes, the blockchain is very interesting. Now you've got incumbents, you've got traditional financial institutions looking at things like custody of cryptocurrencies. So they're starting to understand. They've discovered crypto. On the other hand, the libertarians have kind of discovered laws and have realized that if you start doing unregulated securities offerings, then the SEC comes to get you if you're in the US and similarly in different countries around the world. So they're kind of waking up to the fact that you can't just do whatever the hell you want. Occasionally you have to behave, and there are good reasons why certain rules exist, and mainly it's to do with duping the public. So when there are no rules, people can scam the public, and the uninformed public, they throw money at, and then they lose all their money. So that's generally bad. So these guys are this year, and it started last year, but it's really happening this year and going forwards. They're kind of meeting in the middle in this arena called STOs, or security token offerings, or the tokenization of financial security. So what do I mean? Stocks, bonds, cash, warrants, any swaps, anything which is a financial security, which, if you think about it, doesn't exist physically. It's just an agreement between two or more parties, typically an issuer and an investor. Okay, and these agreements can be recorded, they can be printed out, they can be recorded as PDF files, they can be recorded in smart contracts on blockchains. So what am I seeing? What's being built out today? It's everything. It's the entire traditional, it's like a mirror of the traditional industry, securities industry. So if you see, there's issuers and there's investors. So on the issuance side, you've got the services, the advisors, the people who wander around with PowerPoint presentations and tell you to pay them money and they'll help you. You've got companies the tokenization platforms, companies that help you create smart contracts on whatever blockchain you ask them to create it on, whether it's an ERC20 on Ethereum or whether it's a token on Corda. And you've got a whole bunch, on the issuance side, you've got a whole bunch of innovation with regard to automated, or the automation of processes. So no one likes KYC, but it has to be done. So, 5 years ago, when you went into a bank and opened a bank account, I don't know what it's like in Greece. I've never had to do it personally here myself, but typically, for example, in Singapore, where I'm from, you go in physically, you have to hand over a whole bunch of documents, and you sign some stuff physically, and then you've already given them your passport, which has your name in it, and then they also ask you to write your name in this box with a pen. It's like, guys, come on. But now, if you look at some of the app-based banks and the app-based not just banks, but the crypto sides, it's ID selfies, it's sucking data from other repositories. It's a much easier and therefore cheaper process. It's better for investors, it's better for issuers, and it's much cheaper, and it's still compliant. So all of that's being built out on the issuance side. Then for the investors, we're seeing the new generation of wallets, software for funds. So wallets is typically some software which is used by an individual investor, but a fund might want some more institutional grade things like reporting, and they've probably got more assets floating around. They need more audit trails. They've probably got multiple staff. If you need to make a payment, someone needs to create it, someone needs to approve it, and if it's large enough, the CEO or someone needs to have final approvals. All of these bits of software are being built out. They may not be ready for prime time yet, but this is happening. Put your phones down. This gets better. I'll let you know when you can take a photo. And then in the middle as well, the infrastructure. So we've got the issuers, we've got the investors, but in the middle you've also got the exchanges, the market makers, the custody solutions, the third-party custodians. So all of this it looks like the traditional financial services industry, and it is, but it's being built out for the tokenized world as well. Hopefully it's being built out so it's cheaper, better, faster, more efficient, and more delightful for both the investors and for the issuers. So that's being built out. But what are they servicing? Well, these things are financial securities. So the whole life cycle of a security from start to finish also needs to be thought through. It's not as simple as chucking out an ERC20 and going, there you go, there's a share, deal with it. Because things happen to shares. There are stock splits. There are dividends. People need to vote in shareholder meetings. There are takeovers. There's a whole life cycle. So this kind of life cycle, going from issuance, where you kind of create the assets in the first place, you need to register them with the relevant authorities. It's very early in the morning, and had a big kebab last night. Excuse me. The settlement, how you're going to settle, and what defines settlement. How do you know when a share has moved from my ownership to your ownership? Do you wait 1 block? Do you wait 10 blocks? Well, fortunately, in some of the private blockchains, which I'll talk about in a sec, perhaps there are no blocks, and you get finality of settlement. The servicing of those assets, which is something that hasn't been discussed enough. So how do you do dividends, on-chain, off-chain? Who's going to affect them? Who's going to do them? Do you lock up money into a smart contract, and then the smart contract pays out the dividend? Well, how much money do you need to fund into the smart contract, and when do you do that? All of these questions need to be figured out. And of course, the bits that most people are familiar with, which is the exchanges. The exchanges need to list the assets and then facilitate the buying and selling of those assets. So that's kind of what's being built out. I saw it starting kind of last year, the year before. It's really getting some traction this year, and then next year I think we'll see a lot more of these come to market. Okay, you're good. You can take that photo. All right. Okay. So I've mentioned the word private blockchains. We know about public blockchains. This morning there were some comments about how private blockchains aren't going to be successful, etc. So let me kind of explain how I see the difference between these private networks and these public networks. So firstly, the problem statements, the things that people are trying to solve are really different, in fact. So what's the problem statement for public, where public blockchains are the answer? Well, it's, in Bitcoin's case, it was to create an unstoppable method of transferring value around the world. Okay, that was the purpose of Bitcoin, to make sure that someone can pay money or value from anywhere to anywhere around the world over the net without needing to use a specific financial intermediary. So that's the problem statement. And in Ethereum, it's how do we create an unstoppable world machine that always executes the code you throw at it. On the private blockchain side, that's not the problem statement. That's not the challenge we're trying to solve for. In the private blockchains or enterprise blockchains, we have existing businesses who do business with each other. How do we make them more efficient? So typically in a company, your IT stack is really efficient within your company. You may not think that, you may think your systems are shitty or whatever, but they're pretty good within your organization. And then you have another organization which has a pretty good IT stack. And it's when they have to talk to each other That's where the level of technology really falls, whether it's bits of paper, whether it's faxes. Sometimes it's a PDF file, which is a photograph, basically, sent by email as an attachment from one to the other. And that's why so much reconciliation happens and so many costs and so many errors occur when you have business-to-business workflows, because everyone's checking, did the other person do what they say they would do, and what's the status of this invoice? Is it paid? Is it half paid? Is it cancelled? Has it been signed off? So that's the kind of, they're very, very different problem statements. And typically, when you have different problems, you have different solutions. And the solutions are designed to solve for the problems. So of course, private blockchains are architected differently. In terms of network participation, who's allowed to participate, who's allowed to run a node, it's different again. So for public blockchains, by design, we have unrestricted block creators. Anyone can mine Bitcoin if you throw enough capital at it, buy your machines, get your ASICs and start mining. Anyone can run a node and validate transactions. By design, there's no gate, because if there were a gate, it wouldn't be unstoppable. But in the private world, hey, we're just doing business between each other, trying to make that more efficient. So you can gate the participants, you can restrict the roles. Your job is to do this, your job is to do that. So we don't have to, so the architecture is different. In terms of the identities, again, by design in public blockchains, by default, your identity is unknown unless you wish to say in public, this public key is me. Right? You wiggle your mouse, you get it, or you throw some dice or whatever, you get your public key, and that's your identity. But by default, by design, it's not tied to a real-world identity. Whereas in the real world, businesses want to do business with with businesses that they know who they are. So it's the opposite. In terms of verifying transactions, in public blockchains, it's typically the whole network can validate transactions and create consensus among each other. And that's, again, by design. So it takes 51% of the mining power, or whatever it is, to create an alternative history, an alternative blockchain, and subvert the network. In private blockchains, we have parties, we have nodes that we trust. We don't need this. And as a result, for transaction throughput, or what some people say called scalability, in the public blockchains, you have bottlenecks. In Bitcoin, it's like 4 tickets a second. In Ethereum, it's like 10 or 12. These are getting better, and there are more solutions being developed, as we heard from Adam earlier, to increase the scalability. But at the base layer, they're still pretty slow on a global basis. Whereas on the private side, it's much more scalable. Accenture did a study on Corda with the DTCC in the US and found they could do upwards of 6,400 trades a second. So 6,400 compared to 10. It's much more scalable. And in terms of governance, for public blockchains, they seem to be governed by Twitter arguments, Reddit, and meme wars. And again, that's by design. If there was someone governing it, there'd be a throat to choke, and you could stop it, perhaps. Okay? Whereas on the private blockchain side, the governance tends to be like organized, formalized, and there's a legal basis for who's responsible for this. If it goes wrong, who do you sue ultimately? Okay. All right. So they're the main categories of differences that I see between kind of public blockchain networks and private blockchain networks. Is anyone old enough to remember these guys? Spice Girls? Good, we're awake. Okay. So here's what I think we want when it comes to shares, bonds, securities, investments. We want an end-to-end digital experience. That's what people want. We don't really want to talk to people once we've made our decision. I just want to click on stuff and own it. We want the benefits of digitized things, but without the downside that things that are digital are easy to copy and paste and have 2 of them and double spend them. So we want this ability to have unique digital assets. And I get the impression we don't like all-powerful third parties who, once they exist and they have a kind of monopoly or a pseudo-monopoly, they can crank up the pricing, they don't have to innovate anymore, they sit back and they just like make a load of cash for their shareholders, yet you have to use them. So we don't like those kinds of parties. And what do we get? We think we're going to get better liquidity, we think we're going to get 24/7 markets, so the ability to trade around the clock instead of trading only when the markets are open. Cheaper and faster settlement, we hope. Interoperability across asset classes and systems and not have silos. For certain big ticket items, I see in the narrative people like the idea of fractional ownership. To a certain extent, we can already do that. So if you're familiar with real estate investment trusts or REIT, REITs, a REIT is typically a fund that goes and buys a bunch of one or more buildings, and you can have a small share in that. So we can already do fractionalization, but there is a cost, and it can be a pain if there are lots of little tickets in that. So perhaps with technology we can massively reduce that cost and make it easier for people to participate. We hate excuse me, I hate it so much I choked. We hate complying with regulations, but they are there, they do exist, and if we can automate that and make it go into the background, then we're happy, and also the regulators are happy because they're getting the data they need to make their decisions. And what's really important is transaction finality. This is a concept that I know exactly when what's mine becomes yours, and we don't quite get that in public blockchains. And that's really important for financial securities. It's less important for non-financial things. So things like CryptoKitties, if you're not sure whether your kitties are breeding or not yet, you don't mind waiting 10 minutes, that's okay. But for financial security, it's really important to know exactly who owns it and when. So oh no, my emojis have come out badly. Boo, okay. So Corda is the private blockchain that R3 is responsible for creating. It's open source. We heard this morning that maybe the creators of these blockchains have some sort of control over them. Well, Corda is open source. You can go to github.com/Corda/Corda and download it and use it without telling R3. And you can go ahead and create digital assets and move them around, create your own networks. It's okay. We don't have forks, 51% attacks. It's much more scalable. We've got a different kind of privacy model. Some of our users don't like the fact that on a public blockchain, everyone sees everything. So with our architecture, we move data around in a very different way. So those of you lucky enough to come to the workshop yesterday did some coding and created an application on Corda and saw how data moved around, how assets moved around. We don't get orphan blocks. The programming language is Java, which is much more widely known and kind of stress tested than some of the newer programming languages that exist for public blockchains. Again, people like control over participants. Predictable pricing is important. So with public blockchains, there are two things that can change. One is if the blocks get full, you need to pay more gas or you need to pay a higher transaction fee to get your trades confirmed in Ethereum and Bitcoin. So you're never quite sure how much it's going to cost you to get your ticket confirmed onto the blockchain. And not only that, as the price of Ether and Bitcoin goes up and down, there's another variable that you need to kind of understand and control for. So you really don't know how much a transaction is going to cost you until you make it. And businesses don't like that. Businesses want to know, if I do this many transactions a year, here's how much it's going to cost me ahead of time. I suppose you can hedge it in a little bit, but I don't know. So in private blockchains, you can create predictable pricing where you're like, each ticket's going to cost 10 cents or whatever, and just execute on that. And of course, there is platform governance and a roadmap and someone to point at if things change. I love it. So do we start with private markets or public markets? Public markets, so shares on stock exchanges, are already quite efficient. You can typically, in many countries, you go to your banking app or your broker, you can click and you can trade multiple times a day, and it's pretty easy. But in the private markets, we're still dealing with PDF files, okay, which are photographs of documents, and it can take weeks to finalize a transaction. It doesn't have to, it can take days, but it can take weeks to finalize a private investment. And that's why I've given it that emoji. It's pretty dull stuff. And what we're trying to do by tokenizing these private market securities is move to this kind of paradigm where it's just a more delightful experience for the investor and therefore also for the issuer. So that's what we're trying to move to. As R3, we build Corda, the platform, the protocol if you want. We build tools on top of that to help developers develop their apps. And then the apps are actually built by people who aren't R3, so our partner ecosystem. And we support, while we make Corda the best blockchain it can possibly be, we also support our users and help them partner up and do business with each other. A couple of case studies. One is the Swiss Digital Exchange. So SIX is the digital exchange, is the exchange from Switzerland. They're building a whole new stock exchange using Corda as the blockchain, using Corda to record all the shares, and that does issuance of assets, exchange, and custody. So it's doing the full suite of kind of things needed for securities. So they've decided to leave their existing stock exchange as it is and not try and upgrade it because that's really difficult, and build a whole new one. So that's really interesting, and they're scheduled to go live something like the middle of next year to issue, exchange, and custody digital assets. And another example is HQLAX, which is a European, it stands for High Quality Liquid Asset Exchange. So the way this works is a token represents a basket of government bonds. So one of the problems is how slow it is to move bonds from owner to owner. So what they do is they hold the bonds in custodians traditionally, issue the token. It's like a stable coin, I guess, backed by these bonds, and then the token can move around really quickly at the speed of, at the speed of blockchains or at the speed of emails, 24/7 instead of only when the custodians are open or only when the markets are open. So that's another real-world example of this technology being used to make the investment process much better. And that's it from me. Thank you very much indeed.